Good afternoon, everybody. This is the closing bell here at MarketStream.live, and I am Joe Cusick with the Cusick Group Securities offered by Money Block. And we had a day like we haven't had in a while. Consistently across the board, we have seen one thing that we have not seen. I can't remember the last time I saw across the board volatility. Now, we've had some decent two-sided action. What is that? Well, one day up, one day down. But the volatility hasn't really shown itself until today. You had the VIX index, that fear index. It's coming off its low, so being up 1.5 points, that doesn't sound like a lot. But being up 13%, that sounds like a lot. And I guess technically it is, but fundamentally it's still well below its mean or average, which is right around those probably upper teens to low 20s. All it's telling you is right now there's a heightened sense of potential risk. And it makes sense because let's just be honest. With the Dow Jones now trading at 21,320, it's done something that it hasn't done basically in the last 4 sessions and really hasn't done almost since May, and specifically May 15th. And that is settle below its 20-day moving average at 21,320. It is right at the 20-day moving average. We're going to watch that closely. That means the short-term bulls in the Dow are being put on notice. Now, the reason why the Dow held up much better than some of its other peers, you saw some large cap names like Boeing, United Airlines, and the banks holding up well into this pullback. Taking a look at the diamonds, what you can expect for tomorrow is a range of around about $1.25. It moved $1.44 today, still pricing in about 0.6% move going into the close of business tomorrow. And you're also seeing about 1.2% going into the end of next week as far as potential range. So you got basically $1 and some change being priced in for the remainder of this week, and you have $2 being priced in into the end of next week. Taking a look at the S&P 500, as I had just said, finance held up. The banks specifically, and brokerage firms. But you're also seeing that some large cap tech was holding up. But not large cap tech, that was the drag. But that just could not hold up the S&P enough to stay above its 20-day. And it now settled at its 50-day moving average, actually a little bit below. At 2,409, the 50-day moving average comes in at 2,412. Now, technicians are going to call this one out. We haven't seen it settle below the 50-day moving average, which is that institutional moving average in my world, since basically May 15th of this year. So you've seen a couple months of just grindy upside, and it's pulled back. This has a lot of bulls on notice, especially institutions. We're going to watch this one closely because, as I had stated, you have the majority of the market under pressure as far as large cap tech, but you have finance holding up. With bonds selling off as hard as they have, there is a positive to that. That money that was in bonds is now starting to move somewhere. Where is that? Well, they could start at finance, and then it's going to be other sectors that are going to benefit if, in fact, the landscape hasn't completely changed as far as bias. Now, right now, I'm not saying it is. As a matter of fact, I think that this is probably a momentary thing because really fundamentally not much has changed except for the fact that you have a very hawkish Fed, which is why the bonds are pulling off. You have a hawkish ECB, and you have a pretty solid People's Bank of China. The only central banking group that kind of is on the fence, especially about inflation, is the Bank of Japan. Now, taking a look at the SPY, which is the ETF that tracks the S&P 500, implied volatility actually got up there. The rank is now at 16, which doesn't sound like a lot, but it was at 9 a couple weeks ago. For you new viewers, that just is a gauge for me of telling me if it goes higher, in other words, into the 40, 50, 60, up to 100, that gives me a heightened sense that there could be some violent moves either up or down. Now, they've been moving to the downside pretty briskly today. Let's see if that continues tomorrow. In the spiders, expect about $1 range, either up or down. And into next week, they're pricing in about $1.90, either up or down range in the spiders that track the S&P 500. The NASDAQ continues to slide. It tried to rebound yesterday, but the slide continued. It broke 3 sessions ago, actually about 5 sessions ago, the 50-day moving average. As you can see, that breach right there basically got tech bulls on their heels. It looks like the Facebooks, the Amazons, the Netflix, the Googles, the Apples, you name it, it's been taking a hit over the last 5 sessions. These are stocks that the market has been riding on its back basically since after the first of the year. These are the main stocks that have been driving the market to the upside, and now they're starting to pull back. The NASDAQ down 50. Watch the QQQs. This is the ETF that tracks the NASDAQ. Right now, the Qs is going into tomorrow, pricing in about a 75-cent range. We'll watch that closely. They have a $2.36 range being priced in. So you're seeing about 2% being priced in either to the upside or downside in the Qs. We'll watch that very closely. The Russell 2000, as I said, that is the heart, the soul, and the canary in the coal mine for U.S. domestic stocks, small caps, these small businesses, small community businesses, small banks. These are the ones that will start to take it on the chin if there's any shift in the economy here in the U.S. And right now, they've breached the 20-day, are now resting right on the 50-day moving average at 1,400. They're at it at 1,399 is the 50-day moving average. Folks, if you see the Russell 2000 start to taper off and get below that 1,390 and start to challenge that 1,380 level, that is negative sign. That is a potential red flag for any further momentum to the upside in the short term and intermediate term. I'm going to watch that very, very closely. IWM right now running at around a 25 implied volatility rank. That's the highest of the major indices right now. That means that there is a heightened sense of potential movement. Now again, where I get concerned about violent moves is when it gets well north of 50. So if you hear me say an IV rank of 70, that means that there's a heightened expectation of big violent moves either up or down. And as far as the IWM, which is an ETF that tracks the Russell 2000, pricing in an 87-cent range going into tomorrow and a $2.28 range going into next Friday. So we have some decent movement being priced in, about 0.5% for tomorrow and about 2% next week. Another one that was on a mover was crude. Crude really tried to rally after what was a decent draw from the strategic reserve, I should say strategic reserves, but from the storage. About over 6 million barrels were drawn from the crude inventory, but that still wasn't enough, folks. We still had record output, and we continue to have record supply. The other thing is that we saw that we're importing far less than what we have in historically. So at the end of the day, while the bulls saw that as a relatively positive number, I still believe that $45 to $44 level, that's going to be a sweet spot right now for crude. No pun intended for the light sweet contract. Right now, I just don't see it moving much above there. It's below its 50 and it's settled below its 20-day moving average. With that being said, you're now seeing those challenges. They got to have other catalysts. They got to see bigger draws. And we did see a draw in gasoline. We did see a draw in distillates. But we need to see a bigger one to really draw down. And if there's any type of blip or radar on either the earnings that are coming up, economic data, which we had some decent employment data as far as the claims that came in, still relatively low historically. Bottom line is that we just need to see consumption and some sort of global catalyst right now that's going to get people not thinking that inflation is either stagnant or deflationary. Gold just couldn't get any momentum to the upside today. The shiny metal, which is telling me that there's not a huge fear factor in the market right now, because typically gold, when there's fear or fear of just outright price volatility or in inflation, gold usually moves to the upside. Where we did see a flattening was on copper, and that's good for the non-ferrous metal specifically, but also for industrials. Industrials have been under pressure. Watch copper. It gets below that 262.5 level. That could be a definite sign that the infrastructure and industrial plays could come under some pressure. Where we did see some pressure today, one of the worst performing market segments, actually the worst, was the bonds. TLT is the ETF that tracks the 10-year and the 30-year. It's a hybrid. It's called the 20-year hybrid. Basically, TLT is running at an implied volatility rank of 23. Going into tomorrow, it has a 66-cent range, and going into the end of next week, it has $1.49. You're basically looking at about a 0.5% range tomorrow and about 1% going into next week. The tail end of the curve, in other words, the 30-year was the weakest, followed by the 2-year. The 2-year was down 0.7%. The 10-year held up, though, only down 0.3%, and that's something to watch. The 30-year, the long end of the curve, got pounded, down 0.9%. But really where I want to watch is the yield on the 10-year. This is going to be the telltale as far as bonds are concerned. If bonds are going to continue to sell off, which we could see bonds and equities sell off, I don't know if that's a sustained relationship, but it could. It definitely needs to. Both segments of the marketplace are pretty overbought. But bond yields really spiked today, and specifically when you take a look at the 10-year, it's up 1.5% at 2.36%. As I said, these 10-years need to get well north of 240 before you're going to see bond bears really start to gain some traction, meaning that bond prices come down, yields come up. We see that type of consistent march towards higher yields. That means that there's a heightened sense that things are looking pretty good, that the safety trade or the risk-averse trade is starting to pull off, and they're going to start putting their money to work in other areas. And so I want to keep an eye on that 10-year yield. Getting north of 240 is a positive, especially since the fact that if you look at it, less than 2 weeks ago, we were talking about yields down at 2.15%. They're currently at 2.36%, and we're talking about 10 trading days. That is pretty impressive move. Look at this upside pop. It just sliced right through the 20, 50, and now the 200-day moving averages. So let's see. That money's going to have to start working somewhere. And if it's not in the bonds, we're going to have to see if it's going to start putting itself to work in the equities. Now, those equities could be either here in the U.S., it could be in Europe, or it could be in Asia. So that's why you got to stay tuned to MarketStream. Tomorrow morning, we're going to talk about Asia, and then also we'll talk about Europe, as well as the opportunities here on the opening here in the U.S. So you're getting it all here, folks. Plus, we did a great piece today on retirement. Kind of things that you have to look at for setting up for retirement. Are you ready for retirement? What do you need to know for that? The numbers. We're breaking it down. So bottom line is if you want to spend $50,000 a year in retirement and you don't want to touch your principal, you want to live off of that, I'm going to tell you, if you want to retire and you want to take out $50,000 a year, you got to have $1.25 million in your account, and then you have to have an annual return post-retirement of 5%. Minus taxes and any other expenses as far as trading is concerned. And if you can do that, you'll be able to, you will not outlive your principal. You will actually be able to have your principal available, especially if you're going to need it for emergencies or whatnot. So folks, go check it out. It's a great video, a little bit longer than usual, but I think you'll enjoy it. All right, we'll see you tomorrow morning, and thanks for watching MarketStream.live.